All right. Good afternoon, everyone. Thanks for having me. It's an absolute pleasure to be here again at Westchester Country Club for SPAC Conference 2025. What a difference a year makes. $11.5 billion of issuance year to date. While that sounds significant, and it is a significant uptick versus less than $2 billion this time last year. It is not, the market is not ahead of itself. There is a remarkable number of private businesses that need to access the public markets. And if they don't have the option of getting out the traditional route, the closest thing is the de-SPAC. So today I'd love to talk about some of the structures. So when you talk to your underwriters, there's basically two different common structures, which is units with warrants, units with rights. On the rare occasion, there are common shares issued, but those are kind of a unique and an exception. So you'll see here a little bit of a comparison of warrants versus rights. Right, so SPACs are issued in units, and there is a component that comes with it, the warrant or the right. And that is basically to fill the gap in the discount that the common share trades at that we'll look at momentarily. Warrants provide leverage to both the sponsor, who will receive warrants with their risk capital, as well as investors. So in a good transaction that trades up north of 10 post-close, you can apply a Black-Scholes to it, so you're able to capture time value of money. Tradability, very liquid. It's actually the most liquid component of a unit once a unit is separated, approximately 52 days after the IPO. And part of the pitch from a sponsor's perspective to a target business is they effectively act as a built-in secondary. So they're struck at $11.50, a premium to the $10 issue. At $18, you can call the warrants when they trade 20 out of 30 days above that price, and you'll raise additional capital. The rights, on the other hand, the most common right structure is a 1/10 share. So at the time of the de-SPAC close, 10 rights automatically convert into one freely tradable share. So investors like rights because they have more value at the outset versus a warrant. However, in a good de-SPAC transaction, they in fact are less valuable than the warrant. That automatic conversion is pure dilution, which puts pressure on a sponsor's promote at the time of de-SPAC. Rights do have the effect of providing additional shareholders, which more often than not can be an issue at the time of the de-SPAC close. So that is beneficial to the de-SPAC transaction for listing on NYSE or NASDAQ. If the stock performs very well over time and is effectively over that $18 mark, in fact, rights would be less dilutive than warrants, because if and when you have that opportunity to call the warrants at $11, there's obviously a big spread between where that common share is trading and where you're actually raising capital. So investors, more so sponsors, have to decide what is the better tool for them for which to transact. So they've got to consider the dilution of the warrants. There's complexity to warrants at times, cashless exercise, redemption clauses. Accounting treatment has surfaced as an issue in the past, where the warrants are either classified as liabilities or equity. Rights, on the other hand, as I mentioned, straightforward dilution, puts pressure on a sponsor promote. So It makes it all the more important that you have a sizable operating business that you're merging your vehicle with in order to overcome that additional dilution. And then there's post-de-SPAC trading with rights, where the conversion of those rights into common shares that are freely tradable often end up in the hands of unnatural equity owners. And so unnatural equity owners are going to be more apt to sell versus hold. And so we've seen points of weakness post-de-SPAC more so in rights transactions versus warrants. Starting around Q3 last year, we started to see units that were overfunded. So in order to come to market, there was the need to overfund your SPAC vehicle. What does that mean? That means sponsors had to put up additional capital so that there was more than $10 in the trust account. And it's very specific reasons that I'd like to get into as to why. But looking at issuance starting in Q3 last year to date, in Q3 last year we had 18 SPAC IPOs. Just over half of them were at $10 in trust. Now the duration of those $10 varied from anywhere from largely 18 to 24 months with the odd 15-month in there. And then you had several overfunded, almost half. Q4, we had over 60% that were overfunded. And you had 39% that were $10 in trust, once again with varying duration. Fast forward Q1, once again back to 50-50, and now in today's environment, almost 3/4 are $10. And when we flip the page, you're going to see why this is. So when your underwriter is talking to you as to structure and what the market will accept, what's going to clear the market, the goal is always to get it to trade at 10.01, right above issue price. What was going on late last year that required overfunding was that there was a lack of value in the component parts. And that was because we had all that paper from 2022 that was washing out, that was still around. Most, if not almost all of it, ceased to exist by year end. And as a result, you had a lot of SPACs out there that had returned most of their capital, likeliness of transacting very low, and it dragged down the valuations of rights and warrants. And so if we look at the top, in September 30th, 2024, common shares were trading at a 0.86% discount to cash, right? So that's just under 1%. And you'll see it again in Q1, it was just over 1%. And I'll talk in a second as to why that was important. But that discount meant that the common share on a new issue would trade at $9.91. And so you need that component part to fill that void to get you to 10 or greater. And that wasn't available in the market with, this is based off of the 3 cents you see associated with warrants is based off of the stub warrant that you would get in a unit. So most common form is a half warrant unit. So a half warrant would be worth 3 cents, in total $9.94. And that's why we saw in Q3 into Q4 IPOs consistently breaking price, because there wasn't enough value to trade at issue or a premium. So you started to see the advent of rights where they had largely been for foreign SPACs. You had one of the most notable financial sponsors, or SPAC sponsors that's not a financial sponsor, in the Eagle franchise, Bold Eagle, decide to utilize rights. And this acted to kind of validate the right structure. And they chose to go with the right because their target business and their previous transaction would not accept warrants. So they had to take out the warrants to provide a clean equity capital structure. And so with a high-profile team all of a sudden you start to see more come to market. But more so they came to market because there was more value in that 1/10 share. And so as of the end of September, a 1/10 right was trading at 11 cents. On top of the discount to the common, all of a sudden you hit that bogey that you need to hit to issue your SPAC. So underwriters started saying, hey, if you want to get out without overfunding, you need to go out with a right. So things started to turn in the beginning of the new year. We very quickly saw twice the number of institutional investors participating. We started to see an uptick in component values. So you see here, there was actually a slightly deeper discount in the common share of 1.1%, but now you've got warrants trading at 9 cents for that half a warrant, so whole warrant, 18 cents. And rights start to inflate to 16 cents. So under the warrant structure at $10, you're closer to the $10, but you're still at a discount. So there's still pressure from the institutional investment community to provide more value. So they wouldn't break price. So you saw yet more rights deals come to market. Fast forward several de-SPAC announcements that have traded up above the cash and trust have once again provided volatility and embedded optionality to the common share that hadn't existed in the vehicle for several years. So as a result of that optionality, all of a sudden at the bottom you can see common shares only trading at a 0.35% discount to cash. And all of a sudden there's once again value in the component parts. Warrants, that half warrant trading at 15 cents, whole warrants 30 cents. Rights stabilizing at 19 cents. So all of a sudden there's less discrepancy between the warrant and the right. And now you've got some of the parts over 10.10, which as a result of that optionality in the common share and units trading at premiums, we've seen a tremendous number of institutions come back into the market. So our most recent transactions had nearly 100 institutional investors participate, where Q4 last year bottomed out as little as 30. So dramatic recovery. Pros and cons of everything. You've got some frustrated investors when it comes to allocations. Positive, you got more eyes on the back-end de-SPACs. And what's brought some of these large, notable funds back to market is really the fact that substantial businesses will once again entertain coming out through the SPAC product because we consistently see the traditional IPO window open and close. And as a result, with deals announcing and trading above cash and trust, there's the ability to deploy what they deem to be meaningful capital versus just building SPAC portfolios. And so all this points to, a positive next 12 to 18 months in the product, as there'll be some notable transactions announced and equity capital pursuing. I'd like to point out the discount to cash at the bottom that I've mentioned. We see it historically trades around a 1% discount, and there's a very specific reason behind that number. You think about today's risk-free rate at about 4.25%. Trusts, which are invested in T-bills and or money markets that invest in T-bills, have a little bit of drag, are yielding about 4%. So a little bit of a discount to the risk-free rate. So the discount to the common share basically acts like a zero coupon bond. And 1% is basically 0.5% annualized. So if you take that 0.5% annualized and the 4% of interest that's being earned on the trust, you get to 4.5% and just above that risk-free rate. So that's how investors are looking at the product. So they've got to make a little bit more than a risk-free rate, and then the warrant and or right provides upside for putting their capital to work today for an announcement that's going to come in the future. This slide's a little too busy to read from the audience. But the only thing I'd like to point out here is a little bit of dilution difference between rights and warrants, which if you look at the target company equity value under rights at $10, it's about $1.3 billion, whereas under warrants it's $1.273. There's a difference. You've got to account for the dilution of rights in your transactions, which means as a sponsor, you've got to get an even greater discount under a rights structure, which is possible. Once again, it all comes down to the sponsor. What is the best tool for them to transact? Do the businesses you're talking to care if there are warrants outstanding? Are they going to put pressure on your promote because of the dilution from the rights? Every sponsor is different. So let's talk a little bit about the effects, once again. Warrants tend to trade a little better post-SPAC than rights. There is the ability to hedge against warrants. That's what originally drew the convertible ARB community into the product. But there's no shortage of notable SPACs that have grown through that warrant overhang and ultimately called their warrants. Rights provide dilution upfront at SPAC. You have some unnatural equity holders that put pressure on the common share post-SPAC. So you need to have equity investors at the time of close to help support the equity price. So you've got to generate that demand that can absorb those additional shares that come to market. But yet there's several examples of transactions that work through that short-term pressure to ultimately perform well. Redemptions. Redemptions are, that is always the concern going into a SPAC transaction, how to manage that process. It's going to sound easier said than done, but it ultimately always comes down to the operating business, and more importantly, the valuation, fully diluted, that you're coming out at. The goal, once again, easier said than done, is to price a transaction at several turns cheaper than the public comps so that the long-only and institutional hedge fund community are going to want to own that business alongside the similar businesses that they have in their portfolios. Easier said than done, but that is the ultimate goal. In cases where there's not enough capital, there's various forms of structures that could be implemented, non-redemption agreements. Some forward purchases that can be done late. But the goal always is to get out there, market the transaction to the institutional investment community that owns those operating businesses. And that's where the benefit of working with a full-service investment bank comes in, where you've got sector specialists, you've got sector research coverage, because that's going to help with exposure. And that's what you need. You need to have an active capital markets campaign to help work through the difficulties of the nuance of this structure. So with the limited time left, I'd love to open it up to any questions. Anyone? Anyone have an underwriter telling them to overfund? Sure.
Any question about Turkish companies?
Okay.
Interested about SPACs, but there's some challenges between Turkey and here. So this agreement between They did the SPAC in America a couple of years ago. You know, it's offered $10 and then dropped to $1.
Right.
So that was actually, it was kind of bad reputation for Turkish companies. That's what I do as a Turkish companies and the SPAC sponsors. So I guess that company maybe they had, not the revenue base, it was a bit slow. But for the future representations for investment banking, how the Turkish companies should be come to you or how to be protected from this?
Okay, I'm most certainly not an expert on Turkish companies, but I could definitely address foreign business coming to market through a SPAC. Foreign businesses are typically going to trade at a discount to U.S. businesses listed here in the U.S. So that means the business needs to be larger to garner closer to a market multiple because it is going to get a discount. It becomes all the more important that it's priced at a discount and a substantial discount. So it's got to be truly beneficial for that foreign business to list here in the US. And there are reasons. We see Asian businesses list here all the time because technology multiples are much higher than their local exchanges. There's an example of a transaction in the market that's been very well received. Kyivstar, going public through Cohen Circle, were a sell-side advisor to the parent company Vion, which is spinning out Kyivstar. So Kyivstar is the largest Ukrainian mobile and broadband operator, does $515 million of EBITDA. It's coming out at 3.6 times EBITDA. That is dirt cheap by US standards. And that's why it's garnering the attention. If that business came out at a 10-time EBITDA multiple, it would fall on deaf ears and would risk trading down post-SPAC. Now, it can still trade down, but you have a lot of institutional investors looking at it because the risk inherent with a Ukrainian business today during war has been deemed priced in. And so they view it as very attractive, looking to hopefully a future where that war ends, as this management is executed brilliantly throughout duress. And so that's an example of a foreign business that values listing so highly that they're willing to come out at a very substantial discount. That works. So it's a tall order, and most businesses may not be willing to come out cheaply enough in order to be successful in raising the capital and retaining that trust. But it's a solution. This vehicle at the end of the day is a solution for a given situation. And that's what every SPAC sponsor is looking for, that operating business that needs them as much as they need that operating business. On the sponsor team, each group, or the banking side? I think it's got to be collective effort. Everybody's got to be bought in from the sponsor standpoint. But I would say the person who sees the most deal flow, who is communicating most frequently with operating businesses, is the one who's most likely to understand sensitivities that those operating businesses have. From the underwriting standpoint, I think it's a collective conversation with the sponsor as to what they deem to be the best tool for them to transact. Because the goal is always, you want to see them transact. You have a vested interest. You're in the same boat. So it's deal by deal.
We've seen over the years a few SPACs without warrants.
Yeah.
Who has that seen have replacement?
Sure. So fantastic vehicle. Elusive for 98% of sponsors. So when you think about, we've seen the most commonly in and around biotech, where there has been one of the notable biotech hedge funds sponsoring who effectively brings in their peers. And so there tends to be a more limited distribution versus a traditional SPAC offering. And those investors are very supportive of that warrant or rightless vehicle because they know that they're more likely to perform right at the time of the de-SPAC versus having to turn over some of the float or grow through a warrant overhang or work through some of the additional supply from rights. But it tends, in the biotech community, to be highly concentrated and focused, and the product has worked well there. We saw Cantor did one with their principal vehicle, and give credit where credit is due. They came up with an innovative strategy as opposed to overfunding, which was required at that time when they came out with CEP. They back-end loaded the overfunding, where they basically said, it was one of the vehicles was $200 million. They basically said, we'll pay 15 cents on liquidation rather than going out at 10.05 or 10.10. But we're not going to pay you 10.05 or 10.10 today. So if we fail or you redeem, we will put up the money so that you get 10.15 plus the interest earned on liquidation. Now, what's particularly interesting is in any other given situation, investors would have demanded that money to be escrowed. But because they were deemed a good fiduciary, people took Howard's word that he would actually fund it at the time of liquidation and or redemption. Will we see more of those? Probably. I mean, it's a substantial amount of money to put up, particularly if, unfortunately, a transaction doesn't come to fruition. But you'll see going forward that it'll be escrowed.